How to turn a small salary into real freedom. Hey, they tell you to save more, invest wisely, and eventually you'll achieve financial freedom. But here's what they don't tell you. Most people who follow that advice remain trapped in a cycle of wage dependency their entire lives. They save diligently, they diversify their portfolios, and yet decades later they're still calculating how many more years until retirement. The uncomfortable truth is that traditional financial advice is designed to keep you working, not to set you free. The system is not broken. It's functioning exactly as intended, and the path they prescribe is mathematically insufficient to produce genuine economic independence for the vast majority who follow it. I've spent my career analyzing systems, probabilities, and the mathematical architecture of wealth creation. What I've observed is this: freedom is not a function of how much you save. It's a function of how intelligently you deploy capital, how ruthlessly you eliminate inefficiencies, and how systematically you exploit asymmetries that others ignore. The difference between someone who turns a modest salary into real autonomy and someone who remains financially dependent for life is not luck, inheritance, or even income level. It's understanding the mechanics of compounding, leverage, optionality, and systemic positioning. Most people approach money emotionally. The quantitative mind approaches it as an engineering problem with knowable variables and solvable equations. Before we continue, if this kind of analytical framework resonates with you, if you want to understand wealth not as inspiration but as mathematics, subscribe now. This channel exists to break down the principles that separate disciplined, systematic thinkers from the emotional majority. Don't miss the next analysis. The first and most critical error people make is confusing income with wealth. They are not the same thing. Income is a flow. Wealth is a stock. You can have high income and zero wealth. You can have modest income and significant wealth. The distinction matters because the path to freedom runs through wealth accumulation, not income maximization. Yet the entire cultural narrative is inverted. People chase raises, promotions, higher salaries, believing that more income automatically translates to more freedom. It doesn't. What it translates to is more consumption, more lifestyle inflation, and often more dependency because your cost structure rises in lockstep with your earnings. Think about it mathematically. If you earn $100,000 a year and spend $95,000, your savings rate is 5%. If you earn $50,000 and spend $30,000, your savings rate is 40%. The second individual, despite earning half as much, is accumulating capital at 8 times the rate of the first. Over a decade, that difference compounds into vastly different outcomes. The person with the higher income feels wealthier, they have the nicer car, the bigger apartment, the vacations, but they are not building wealth. They are building a lifestyle that requires continuous income to sustain. The moment that income stops, the entire structure collapses. The quantitative approach inverts this logic. You start by defining your freedom threshold. What is the minimum amount of capital that, if invested conservatively, would generate enough cash flow to cover your essential expenses indefinitely? That number is your target. Everything else is noise. Once you have that target, the question becomes, what is the shortest mathematically viable path to reach it? And the answer is almost never to maximize income. It's to maximize savings rate, minimize unnecessary expenditure, and deploy capital into vehicles that compound efficiently over time. This is where most people fail. They optimize for the wrong variable. They think the problem is that they don't earn enough, so they work longer hours, take on more stress, chase higher paying jobs. Meanwhile, their spending rises to match. The gap between income and savings never widens. They are running faster on a treadmill that isn't moving them toward the exit. The disciplined approach is to treat your current income as fixed, regardless of what it is, and engineer your lifestyle to extract the maximum possible savings rate. That is the only variable that truly determines how quickly you can buy your freedom. Let me give you a concrete example. Suppose your essential annual expenses, the ones you cannot avoid, rent, food, healthcare, transportation, amount to $30,000. If you can generate passive income of $30,000 per year from invested capital, you are mathematically free. You no longer need to work for money. The system can sustain you indefinitely. How much capital does that require? If you assume a conservative withdrawal rate of 4%, which is a standard benchmark for sustainable portfolios, you need $750,000. That is your freedom number. Now, if you earn $60,000 a year after taxes and you save $20,000 annually, you will reach $750,000 in approximately 24 years, accounting for compound growth at a modest 7% real return. That's not an impossible timeline. It's a realistic, achievable path for someone earning a median income. But here's the critical insight. If you increase your savings rate to $30,000 per year by reducing expenses, not by earning more, you cut that timeline down to approximately 17 years. If you push it to $40,000, you're looking at 12 years. The variable that matters most is not how much you make, it's how much you keep. The emotional investor looks at that calculation and feels despair. 12 years feels too long. They want freedom now. So they take shortcuts. They chase speculative bets, high-risk investments, lottery tickets disguised as opportunities. And statistically, most of them fail. They lose capital, they reset the clock, and they end up further behind. The quantitative mind accepts the timeline because it understands the mathematics. Compounding is slow at first, but it accelerates. The discipline is enduring the early years when progress feels invisible and trusting the exponential curve that emerges later. Another critical mistake is lifestyle inflation. As income rises, expenses rise proportionally or even faster. This is not irrational in a psychological sense. Humans adapt. What once felt like luxury becomes baseline, but it is catastrophic from a wealth-building perspective because it locks you into a higher cost structure that requires continuous high income. You become trapped by your own standard of living. The antidote is to anchor your lifestyle to a fixed level, ideally one that is comfortable but modest, and treat all income above that level as capital to be deployed. This is not deprivation. It's strategic decoupling. You separate your quality of life from your income level, which gives you the freedom to make decisions based on opportunity, not necessity. Think of it as building a firewall. On one side is your lifestyle, on the other side is your income. The two should not be tightly coupled. When they are, you lose flexibility. You can't take a lower-paying job that offers better learning. You can't walk away from a toxic work environment. You can't afford to take time off to retrain or pivot. You are stuck because your expenses demand that income. But if your lifestyle is anchored at a lower level and your income fluctuates above it, you have optionality. You can make decisions based on long-term value rather than short-term survival. That optionality is worth far more than the marginal utility of additional consumption. The other element people misunderstand is the nature of wealth creation itself. Wealth is not created by saving. Saving is necessary, but it's not sufficient. Wealth is created by deploying saved capital into assets that generate returns. And here is where the mathematics becomes critical. The difference between a 3% return and a 7% return over 20 years is not incremental. It's exponential. At 3%, $100,000 becomes approximately $180,000. At 7%, it becomes $387,000. The spread is massive, and it's entirely a function of how intelligently you allocate capital. This is why passive investment in low-cost index funds has been such a powerful vehicle for wealth creation over the past several decades. It removes emotion, minimizes fees, and captures market returns systematically. It's not glamorous. It doesn't require genius. But it works because it aligns with the statistical reality that markets over long periods tend to grow. The emotional investor tries to beat the market, trades frequently, chases performance, and in doing so, underperforms. The quantitative investor accepts market returns, minimizes costs, and compounds relentlessly. Over decades, that discipline produces outcomes that feel almost magical to those who didn't follow it. But even within passive investing, there are nuances. Asset allocation matters. Risk tolerance matters. Tax efficiency matters. The goal is not to find the perfect strategy. It's to find a strategy that is good enough, mathematically sound, and that you can execute without deviation. Consistency beats optimization. A mediocre plan executed with discipline will outperform a perfect plan executed erratically. That is a foundational principle in systematic investing, and it applies equally to personal wealth building. Now, let's talk about leverage, because this is where small salaries can be transformed into significant wealth under the right conditions. Leverage, in its simplest form, is using borrowed capital to amplify returns. It's a tool, and like all tools, it can be used wisely or recklessly. The emotional investor uses leverage to speculate, to chase outsized gains, and often ends up losing more than they started with. The quantitative investor uses leverage strategically only when the expected return exceeds the cost of capital by a sufficient margin, and only when the risk of ruin is mathematically contained. Real estate is the most common example of productive leverage for ordinary people. You put down 20% on a property, finance the rest, and if the property appreciates or generates rental income, you capture returns on the full value, not just your down payment. That amplification can turn modest capital into substantial wealth over time, but it only works if you buy prudently in markets with strong fundamentals and if you manage the asset competently. The risk is that leverage also amplifies losses. If the property value declines or if cash flow is insufficient to cover debt service, you can be forced into distressed sales. The discipline is in using leverage only when the odds are clearly in your favor and when you have sufficient liquidity to withstand adverse scenarios. The same principle applies to business ownership. Starting a business or acquiring equity in one is another form of leverage. You're deploying time and capital to build an asset that can generate returns far exceeding what you could earn through labor alone. But again, the risk is total loss. Most businesses fail. The quantitative approach is to treat this as a probabilistic bet. You don't need certainty. You need positive expected value. If you can structure the investment such that your downside is limited and your upside is large, and if you can afford to lose the capital without catastrophic consequences, then the bet makes sense. But you must be ruthless in avoiding emotional attachment. The market doesn't care about your effort or your intentions. It only cares about results. One of the most overlooked forms of leverage is education and skill acquisition. If you can invest time and money into developing skills that increase your earning power or open new opportunities, the return on that investment can be extraordinary. A degree, a certification, a new language, a technical skill, these are all forms of capital that compound over your working life. The mistake people make is treating education as a consumption good, something you do because it's expected, rather than as an investment with measurable returns. The quantitative approach is to calculate the expected increase in lifetime earnings from a given educational investment and compare it to the cost. If the return is high and the cost is manageable, you do it. If not, you skip it or find a cheaper alternative. But let's return to the core question. How do you turn a small salary into real freedom? The answer is a system. Not a single tactic, but a coherent set of principles executed consistently over time. First, define your freedom threshold. Calculate the amount of capital you need to generate sufficient passive income to cover your essential expenses. Second, maximize your savings rate by ruthlessly minimizing unnecessary expenditure and anchoring your lifestyle below your income level. Third, deploy that capital into assets that compound efficiently, whether that's low-cost index funds, real estate, or business equity. Fourth, protect your system by maintaining liquidity, avoiding excessive leverage, and planning for tail risks. Fifth, Be patient. Wealth accumulation is exponential, which means the early years feel slow and the later years feel fast. The discipline is in enduring the slow phase without deviating. This is not inspirational. It's mechanical, but that's precisely why it works. Emotions lead people astray. They chase returns when markets are high. They panic and sell when markets fall. They inflate their lifestyles when income rises. They take on risky debt to sustain consumption. All of these behaviors are statistically predictable and statistically destructive. The quantitative mind rejects them because the math doesn't support them. Instead, it builds a system designed to survive volatility, exploit compounding, and reach the freedom threshold with mathematical certainty. There's another dimension to this that's rarely discussed: the psychological shift that occurs when you cross certain capital thresholds. The first 100,000 is the hardest. It feels impossibly slow. Every setback feels significant. Every expense feels like a step backward. But once you reach that milestone, something changes. The compounding becomes visible. The returns on your capital start to exceed your annual savings. You begin to feel momentum. The system is working. That psychological shift is critical because it reinforces the discipline. You've proven to yourself that the math works, and that proof sustains you through the next phase. The second threshold, somewhere around 300 to 500,000, is where real optionality begins. At this level, you have enough capital that losing your job is no longer a crisis. You have a buffer. You can take risks. You can walk away from situations that don't serve you. You're not free yet, but you're no longer trapped. The final threshold, whatever your freedom number is where the equation flips entirely. At that point, work becomes optional. You can choose to continue earning for other reasons: fulfillment, purpose, intellectual challenge, but you're no longer economically compelled. That is freedom. Not luxury, not excess, but the absence of compulsion. One of the most insidious myths in personal finance is that freedom requires vast sums of money. It doesn't. What it requires is a cost structure that aligns with your capital base. If you can live comfortably on $30,000 a year, you need far less capital to be free than someone who requires $100,000. The person with expensive tastes is not wealthier. They're more constrained. The quantitative mind recognizes this inversion and designs accordingly. You don't optimize for maximum income or maximum lifestyle. You optimize for the fastest path to freedom, which almost always means living below your means and compounding the difference. But let's talk about risk for a moment, because this is where many people lose their nerve. Risk is not something to be avoided. It's something to be managed. Every investment carries risk. Cash loses value to inflation. Bonds carry interest rate and credit risk. Stocks are volatile. Real estate is illiquid. The goal is not to eliminate risk, but to take risks that are compensated, that offer expected returns in excess of the risk borne. The emotional investor either takes too much risk, chasing speculative gains, or too little risk, hiding in cash and watching purchasing power erode. The quantitative investor calibrates risk to match their time horizon, their liquidity needs, and their tolerance for volatility. A young person with a long time horizon and stable income can afford to take equity risk because they have time to recover from downturns. An older person nearing their freedom threshold should reduce equity exposure and increase stable income-generating assets because they have less time to absorb volatility. This is not complicated, but it requires honesty about where you are in the cycle and discipline to adjust as circumstances change. The mistake is rigidity, holding the same allocation regardless of age, goals, or market conditions. The system must evolve. There's also the question of diversification, which is often misunderstood. Diversification is not about owning a little bit of everything. It's about reducing the correlation of risks in your portfolio so that a single event doesn't destroy you. If all your wealth is tied to your employer through salary, stock options, and retirement accounts, you're not diversified. You're massively concentrated. If your employer fails, you lose your income and your savings simultaneously. The disciplined approach is to separate your human capital from your financial capital. Don't own large amounts of your employer's stock. Invest outside your industry. Build income streams that are independent of your primary source of earnings. That's true diversification. Another principle that's critical for turning a small salary into freedom is tax efficiency. Taxes are one of the largest drags on wealth accumulation, and yet most people pay far more than necessary because they don't understand the rules. Contributing to tax-advantaged accounts, retirement plans, health savings accounts, these vehicles allow your capital to compound without the friction of annual taxation. Over decades, the difference is substantial. Similarly, understanding capital gains treatment, the difference between short-term and long-term rates, the benefits of tax loss harvesting, all of these small optimizations add up. The quantitative mind treats taxes as a controllable variable, not a fixed cost. The emotional investor ignores tax efficiency because it's boring, because it requires attention to detail, and because the benefits are invisible in the short term. But over a lifetime, the investor who minimizes taxes systematically can accumulate 20 to 30% more wealth than someone with identical returns who pays taxes carelessly. That spread is the difference between reaching freedom at 55 versus 65. A full decade of your life. The discipline is in learning the rules and using them to your advantage, which is not evasion, it's optimization. Let's address a psychological barrier that stops many people, the fear of missing out. They see others living larger, taking exotic vacations, driving luxury cars, and they feel deprived. They wonder if they're sacrificing too much. This is where discipline is tested. The quantitative mind understands that consumption is a zero-sum game against future freedom. Every dollar spent on lifestyle today is a dollar not compounding toward independence. The emotional mind craves validation, status, immediate gratification. It wants to signal success through consumption. But here's the reality. The people living the largest lifestyles are often the furthest from freedom. They're locked into high-income jobs they hate because they need to sustain their cost structure. Meanwhile, the person living modestly, saving aggressively, and compounding quietly is building something far more valuable: autonomy. The irony is that once you reach freedom, you often find you don't need or even want the expensive lifestyle. The luxury car, the big house, the status symbols, they lose their appeal when you're no longer chasing validation. What you value instead is time, flexibility, the ability to say no, the absence of stress. And none of that requires wealth beyond your freedom threshold. This is the paradox. The path to freedom requires delaying gratification, but once you arrive, you realize the gratification you delayed wasn't worth having anyway. The real reward was the journey, the discipline, the control over your own life. Now, I want to talk about failure because it's inevitable. Markets crash, investments go wrong, businesses fail, careers stall. The question is not whether you'll encounter setbacks. It's whether your system is designed to withstand them. This is where liquidity and margin of safety become critical. If you're fully invested with no cash reserves, a sudden expense or market downturn can force you to sell at the worst possible time, locking in losses. If you have liquidity, you can weather the storm and even capitalize on opportunities that emerge during distress. The quantitative investor always maintains a buffer, not because they're pessimistic, but because they understand that variance is real and planning for it is rational. The concept of margin of safety extends beyond liquidity. It's about building redundancy into every part of your system. Don't assume your income will remain stable. Don't assume your investments will perform as expected. Don't assume health, employment, or relationships will continue unchanged. Plan for disruption. That means having emergency funds, insurance, skills that are portable, and a lifestyle that can contract if necessary. The emotional investor is optimistic, assumes continuity, and is blindsided when reality diverges. The quantitative investor is prepared for discontinuity, which is why they survive when others don't. Let me give you a practical framework. Divide your capital into 3 buckets. The first bucket is your emergency fund. This should be 6 to 12 months of essential expenses held in cash or near cash equivalents. It's not meant to grow. It's meant to protect you from forced liquidation during a crisis. The second bucket is your growth capital. This is the money you invest for long-term compounding, primarily in diversified equities or real estate. It's exposed to risk, but it's also where the majority of your wealth will come from. The third bucket is opportunistic capital. This is dry powder, cash or liquid assets you hold to deploy when opportunities arise, whether that's a market crash, a distressed property, or a business investment. The proportions depend on your stage and risk tolerance, but the principle is the same. Separate stability, growth, and optionality. This structure prevents the common mistake of being either too conservative or too aggressive. If all your money is in cash, you're losing to inflation. If it's all in high-risk assets, you're vulnerable to shocks. The 3-bucket approach balances safety, compounding, and flexibility. It's not complicated, but it requires discipline to maintain the boundaries. The temptation is always to raid the emergency fund for consumption or to chase speculative bets with the opportunistic capital. The quantitative mind resists those temptations because it understands the system depends on each bucket serving its designated function. There's also the question of income diversification. Relying on a single paycheck is a structural risk. If you lose that income source, your entire system is threatened. The antidote is to build multiple streams, even if they're small at first. This could be freelance work, rental income, dividend income, royalties, side businesses, anything that generates cash flow independent of your primary employer. The goal is not to replace your salary immediately. It's to reduce your dependency on it. Over time, as these streams grow, they provide both a safety net and a path to faster wealth accumulation. The emotional investor sees this as too much work. The quantitative investor sees it as essential redundancy. Let me tell you what real freedom looks like. It's not yachts and private jets. It's the ability to walk away from a job that's destroying your health without worrying about how you'll pay rent. It's the ability to take 6 months off to care for a family member without financial panic. It's the ability to pursue a project you believe in, even if it doesn't pay immediately, because your basic needs are covered. It's the absence of desperation. That's what capital buys you. Not luxury, but optionality. And the path to that optionality is not mysterious. It's mathematical. Save more than you spend. Invest the difference intelligently. Compound for decades. Protect your system from ruin. That's it. No secret formula, no hidden trick, just discipline applied consistently over time. The challenge is that discipline is boring. It doesn't make for dramatic stories. There's no moment of genius, no sudden windfall, just the slow accumulation of small advantages compounded over years. That's why most people don't do it. They're looking for the shortcut, the hack, the one brilliant move that changes everything. And because they're looking for that, they miss the only path that actually works. Systematic, patient, emotionless execution. The market rewards those who can endure the boredom of doing the right thing repeatedly, even when it feels like nothing is happening. Here's another truth. The system is designed to make you fail. Consumer culture, advertising, social media, they all exist to increase your consumption. Financial institutions profit from your activity, from trading fees, from high-fee products, from debt. The default path is to spend everything you earn, go into debt, and work until you're too old to enjoy life. Breaking free from that path requires conscious, sustained effort. It requires saying no to the culture, no to the norms, no to the expectations. It requires building a counter system, one designed for your freedom rather than someone else's profit. That's what the quantitative approach provides, a framework for resisting the defaults and optimizing for outcomes that actually matter to you. Let's talk about time, because it's the ultimate non-renewable resource. You can always make more money, You can't make more time. The entire point of achieving financial freedom is to reclaim time, to use it on your terms rather than selling it by the hour. But here's the paradox. The earlier you start building wealth, the less time it takes. If you start at 25, you can be free by 40. If you start at 40, you might not be free until 60. The difference is 15 years of your life. That's why delaying is so costly. Every year you wait is a year you lose to compounding and a year you extend your servitude. The emotional response is to say it's too late, I'm too far behind. The quantitative response is to start now, because every day you delay makes the problem harder. There's a concept in mathematics called present value, which is the idea that $1 today is worth more than $1 tomorrow because of the opportunity to invest and compound. The same logic applies to time. A year of freedom at 40 is worth more than a year of freedom at 70 because you have more health, more energy, more possibility. The cost of not acting is not just measured in money. It's measured in the years of your life that you spend trapped in the system you don't control. That's the real stakes. Not dollars, but autonomy. Not wealth, but time. So where do you start? First, calculate your freedom number. Be honest about your essential expenses. Don't inflate them with luxuries you think you need. Second, calculate your current savings rate. Income minus expenses divided by income. That's your velocity toward freedom. Third, identify the inefficiencies in your spending. Where are you leaking capital? Subscriptions you don't use, meals you could prepare cheaper, transportation you could optimize. Every dollar recovered is a dollar that can compound. Fourth, automate your savings. Set up transfers so that capital moves from your paycheck into investment accounts before you have the chance to spend. Fifth, choose a simple, low-cost investment strategy and stick with it. Don't chase performance. Don't react to news. Just execute the system. Once the system is in place, your job is to maintain it. Review your progress quarterly. Adjust your allocations as you age or as circumstances change. Increase your savings rate whenever your income rises. Resist lifestyle inflation. Stay disciplined through downturns. The compounding will take care of itself. You don't need to do anything brilliant. You just need to not do anything stupid. That's the essence of systematic wealth building. Avoid catastrophic mistakes, stay in the game, and let time work in your favor. I want to address one more barrier. The belief that this path is joyless, that you're sacrificing the present for a future that may never come. That's a false dichotomy. Living below your means doesn't mean living miserably. It means aligning your spending with what actually brings you value and cutting everything else. Most consumption is mindless, habitual, driven by external pressure rather than genuine preference. When you strip that away, you often find you're happier, not less happy. You have less clutter, less stress, less noise, and you have more of what actually matters: time, relationships, purpose, autonomy. The discipline of building wealth forces you to clarify what you value, and that clarity is itself liberating. The other realization that comes with pursuing freedom is that the journey matters more than the destination. The skills you develop, the discipline, the clarity, the resilience, these are valuable regardless of whether you reach your target. You become a different person. You stop being a passive consumer and become an active architect of your life. That transformation is worth more than the capital itself. Because even if you never reach complete financial independence, you'll have more control, more options, more agency than you would have otherwise. And that's the real goal. Not to stop working, but to work on your terms. Let me leave you with this. The world is full of people who will tell you it's impossible, that you need to earn more, that you can't save enough, that the system is rigged. They're wrong. The system is difficult, but it's not rigged. The math works. Thousands of people with ordinary incomes have walked this path and reached freedom. They're not geniuses. They're not lucky. They're disciplined. They understood the variables. They built a system, and they executed it without deviation. You can do the same. The only question is whether you will. Because the opportunity is there, the tools are available, and the timeline is knowable. What's required is the decision to start and the discipline to continue. That's not inspiration. That's mechanics. And mechanics, when applied correctly, produce predictable outcomes. The market doesn't care about your intentions. It doesn't reward effort or hope. It rewards disciplined execution over time. If you build the system, protect it from shocks, and compound without interruption, you will reach your threshold. That's not faith. That's mathematics. The data doesn't lie. The cycles are real, and the path to freedom, for those willing to walk it, is clear. So stop waiting for permission, for the perfect moment, for conditions to improve. Start now. Define your number, build your system, and execute. The rest will follow.